This is Nightly Business Report with Bill Griffith and Sue Herrera.
Upping the ante, the White House threatens new tariffs on $200 billion worth of Chinese goods, and economists are sounding the alarm.
Portfolio protection. As prices rise, which stocks will get hit and which can weather the storm?
10 years later, IndyMac collapsed a decade ago, shocking the system and giving way to the worst financial crisis in a generation. Those stories and more tonight on Nightly Business Report for Wednesday, July 11th.
And we bid you good evening, everybody. The rumblings of a trade war are growing louder. The U.S. is now threatening new tariffs on $200 billion worth of Chinese goods. China pushed back immediately, and stocks fell sharply today. The Dow Industrial Average dropped 219 points to 24,700, snapping a four-day win streak. The Nasdaq was down by 42. The S&P lost 19. And oil was down 5% today on the potential of weaker demand tied to the U.S. trade dispute with China. Kayla Tausche has more now on the intensifying tensions between the world's two economic superpowers.
Handbags, sporting equipment, and building materials among the new items in the crosshairs of the U.S.-China trade war. At the end of August, the Trump administration could slap tariffs on $200 billion in Chinese goods, on top of $50 billion already targeted. China last week began retaliating against U.S. crops. The White House had prepared these new tariffs in response. President Trump tweeting from the NATO summit that he's always thinking about our farmers, saying for years, other countries' trade barriers and tariffs have been destroying their businesses. China's Commerce Ministry said Tuesday it would again hit back with firm and forceful measures. Experts say that toolbox is wide-ranging.
China perhaps has a more diverse set of tools and is more willing to color outside of the lines. The U.S. may have similar measures, but we don't, employ them given our commitment to market values, the liberal economy.
U.S. companies are worried about rising prices and roadblocks to business.
I don't think there's any question that China is a violator on intellectual property issues and technology transfer. Those are all serious concerns. We share those concerns. I don't want to diminish that in any way, but do something about it, but don't do it through tariffs.
Republican lawmakers fear the White House's strategy won't work.
No one at the White House can articulate what it is they're hoping to accomplish. That's what worries me.
I think the president's negotiating, that the longer you negotiate, the better deal you get. But that's what's so concerning, because the uncertainty of it.
The top House Republican on trade, Kevin Brady, called for face-to-face talks between Presidents Trump and Xi. An administration official says the U.S. is open to engaging, but there are no in-person talks scheduled. For Nightly Business Report, I'm Kayla Tausche in Washington.
And as has been the case in the past, China was quick to respond to the threat of new tariffs. Eunice Yoon picks up the story from Beijing.
China says it's shocked and that the U.S. move is totally unacceptable. The Foreign Ministry today called the new tariff threat American trade bullying. The Commerce Ministry said China would immediately file a complaint to the WTO and would have no choice but to respond with countermeasures, though it wouldn't specify what those measures actually would be. People are wondering now how China will react because China only imports $130 billion worth of American goods. So even if it wanted to match the U.S.'s $200 billion threat, it can't. China this week unveiled a plan to safeguard its companies. The Commerce Ministry said it has a four-point defense plan. First, to assess the impact of tariffs on Chinese companies, to use income raised by counter tariffs as relief for Chinese firms. Third, to encourage Chinese firms to diversify imports away from American products, especially for soybeans, autos, and seafood, and to step up the use of foreign investment, use foreign money to help support Chinese companies. The state media said yesterday that the plan shows that China expects protracted action from the United States. I spoke to one American businessman who said more and more companies here are now also expecting that this trade war could be protracted because he said that it looks as though neither side is willing to back down. He said that the only silver lining he sees with this $200 billion tariff threat is that it's a 10% tariff as opposed to a 25% one. For Nightly Business Report, I'm Eunice Yoon in Beijing.
Now, the bigger tariff price tag is starting to add up to real money for some economists. And that means the risks to the economy are rising as well. Steve Leisman has that part of the story for us now.
A massive threat of $200 billion of new tariffs against China by the Trump administration has economists sounding much louder alarm bells compared to previous rounds in the trade war. The new worry is that together with retaliation from the Chinese, this round is so large that it could have meaningful and measurable negative impacts on both U.S. prices and U.S. economic growth.
This is a bit of a dangerous ballgame that we're playing here. And if you look at the worst case scenario and model out what the numbers look like, you could see a full percentage point hit to GDP. You could see inflation higher.
Morgan Stanley writes, quote, "We're now testing the idea that trade disputes are a contained economic event. Tariffs are creating earnings noise and eroding gains from fiscal stimulus." Joseph Brusuelas, chief economist at RSM, says the new tariffs could shave 0.3 to 0.4% off of GDP all the way through 2020 and raise prices. Products covered by the tariffs include parts for motor vehicles, heavy machinery, and tractors, along with clothing, handbags, and seafood. The administration said these tariffs were in response to China's retaliation against the previous U.S. tariffs. Quote, "China has shown that it will not respond to action at a $50 billion level by addressing U.S. concerns with China's acts, policies, and practices involving technology transfer, intellectual property, and innovation." Previous tariffs are already showing up in prices in the United States. The government reported today that wholesale lumber prices are up 23% compared to a year ago following tariffs imposed last year. Government also reports washing machines and metal prices are higher in what the National Retail Federation, a strong opponent of these tariffs, labeled, quote, "the Trump tax."
This is like $1 trillion worth of economic activity potentially subject to tariffs. Tariffs don't work. They never worked. They're not going to work this time either.
One trouble for forecasting the impacts of tariffs is that economists don't know exactly what Trump is after. If these are negotiating tactics, then they could go away soon and have little impact. But Trump and some of his advisors have also said the tariffs are designed to protect U.S. industries and spur production domestically. If so, they could be around for a long time. For Nightly Business Report, I'm Steve Leisman.
And Steve just mentioned today's government report on prices. He was referring to the Producer Price Index. The index, which measures the prices businesses receive for goods and services, rose 0.3% in June from a month earlier. But it was the annual rate that got all of the attention. It climbed 3.4%, a level not seen in 6 years. The reason was partly due to a rise in transportation costs.
And rising fuel costs are becoming an issue for airlines. Today, American Airlines, which is the world's largest carrier, trimmed its outlook for second quarter revenue growth. The CEO in the past has warned of the need for higher fares because of rising costs. And that stock tumbled 8% today, and other airlines followed suit. In fact, the transports were one of the biggest decliners in today's trade.
So obviously, a number of factors are driving up costs for U.S. companies. Higher energy prices, the threat of tariffs, and rising inflation could be seen as headwinds. So how will companies contend with these pressures? Joining us to talk about that is Jason Ware, chief economist at Albion Financial Group. Jason, welcome, as always.
Good to be here.
You know, the tariff conversation is kind of ongoing, so we don't really know yet what the full impact of that is going to be. But you make the point that even if companies aren't reacting right now, it certainly is affecting their confidence.
Yes, I mean, that's what we're seeing early on. And what we know is that, you know, trade wars are bad and they're difficult to win. And depending on how long this gets drawn out, if it's protracted, you know, we might actually start to see that filter into the decisions, the collective hive mind of the private sector on how they, you know, how much they produce, the hiring and firing decisions, investment decisions, et cetera. We're not seeing that yet, but what we are seeing, to your point, over the shorter term is that business confidence is waning a bit, given that we just don't know where this is going to go.
Tight labor market means wage inflation. Energy costs going up means higher cost of production and shipping. Cost of money is going up because interest rates are going up. Tariffs are going up. I mean, it's a kind of a perfect storm now of inflationary pressures for corporate America. Does this mean that we'll see less production down the road? I mean, we had a dearth of capital spending for a number of years because companies were loath to build future factories because they were uncertain about the future. Are we going to go back to that again, do you think?
So the good news is that most of these things that at the core of your question is, are companies going to produce more? Are companies going to invest more? Are they going to expand their businesses? And that is a function more of aggregate demand than it is any of the things that you mentioned. While those things are certainly something that management teams take into account when they're making decisions at the business level. At the macro level, if there's demand for goods and services, then that typically warrants the expansion, that is the hiring of human capital and the investment in productive fixed assets. So I don't think that those things together are likely to put us back to where we were. I still think we're probably on a trajectory of more growth than less, but these things are certainly causing businesses to pause and to perhaps reassess what's going on given the uncertainties around trade.
Lots of things to think about. Jason, thank you. Jason Ware with Albion Financial Group. Bill?
Okay, so if you are concerned about how to protect your investment portfolio from these rising inflationary pressures, joining us tonight is Quinn Tatro. He's president and portfolio manager at Jewel Financial, with names of stocks that he says you might consider and those that you might avoid. You know, it's been a long time, Quinn, since people have had to think about inflation-proofing their portfolio. Is that time near now, do you think?
I think we're pretty close. There's no question all of the variables that you mentioned to begin the show our investors need to be thinking about. And this is the time period where you have to ask yourself, can this company pass the inflationary pressures on to the customer and get away with it? And that's where you have to segment out your discretionary staples from your consumer staples from your consumer discretionary names. Those companies that you have to keep buying from, and those companies that you buy from when you have a little extra money.
So given that, what companies would you be looking at with maybe renewed interest if you feel that part of your portfolio may be vulnerable to those pricing pressures or inflationary pressures?
Sure, this is your grocery store type stock. So you just go through the aisles and you look at your Johnson & Johnson, your Kraft Heinz, companies, again, that you are not going to shy away from when they raise their prices. Coca-Cola, I mean, a Warren Buffett favorite, you're always going to continue to buy your Coke whether they raise it a dime or 20 cents. And then you want to look on the other side and you want to try to start weaning your portfolio away from companies that are going to not have as easy a time to pass that through. That's your Starbucks, for example. Somebody, if they're paying over $3 a gallon at the gas pumps, may not buy that $4.50 latte. Look to that. They might skimp and not take the family to a Disney or something along those lines. So I think you have to be really looking through your portfolio and asking yourself, you know, is this Cheesecake Factory a necessity? If it's not, I think you got to consider selling those here.
Quickly, traditionally in the past, when you hear inflation, you think things like gold. Are you thinking gold here as well?
Absolutely. I've been talking to clients about that, but it has not yet responded. I think gold is really waiting to see those wage numbers increase, which we have not seen yet. But in due time, I think gold and the gold mining space will be also something to consider for your portfolio.
Very good. Quinn, always good to see you. Quinn Tatro with Jewel Financial joining us tonight.
It is time to take a look at some of today's upgrades and downgrades. Dow component McDonald's was downgraded to neutral from buy at Cleveland Research. The analyst expects second half comparable store sales to trend in line with consensus expectations. The firm lowered its sales estimates for this year and next. The shares fell 1% to $158.62. Texas Instruments was upgraded to buy from neutral at Longbow Research. The analyst there calls the stock a semi-safe haven. The price target is $134, but the stock fell more than 1% to $111.76.
Nordstrom was upgraded to outperform from market perform at Telsey Advisory Group. The analyst cited the upscale retailer's long-term growth prospects, put the news price target at $57, and that stock rose 2.5% today to $53.42. Twitter was initiated with a reduced rating in new coverage at Nomura. The analyst expects the social media company to report earnings below expectations next year. Price target $31. That stock rose a fraction to $43.87.
Still ahead, we will take you to the place where the blockbuster deals are born.
It was a NATO summit like no other. President Trump today had some tough words for some of our closest allies, and it all comes down to money. Eamon Javers is in Brussels for us tonight.
Most NATO summits are a series of meet and greets, with everyone in the military alliance signaling to the world that the countries are friendly, united, and ready to fight to defend each other if necessary. But that message of harmony was shattered this morning in Brussels as President Trump had breakfast with NATO Secretary General Jens Stoltenberg and dished out some harsh criticism of Germany.
If you look at it, Germany is a captive of Russia because they got rid of their coal plants, they got rid of their nuclear. They're getting so much of the oil and gas from Russia. I think it's something that NATO has to look at. I think it's very inappropriate.
That prompted an immediate response from the German defense minister.
I do not really understand what he means by that. Hard to say. But in general, yes, if there's a country in the region who has seen the change in Russian behavior, then it is Europe. And within Europe, it is Germany, of course.
And it threatened to make for an awkward meeting when Trump sat down with German Chancellor Angela Merkel hours later. But both sides stuck to pleasantries.
And I believe that our trade will increase and lots of other things will increase. But we'll see what happens over the next period of a few months.
Trump's criticism was directed at an $11 billion pipeline for Russian natural gas. Other European nations have criticized it for making NATO too dependent on Russian resources. The president is also frustrated by what he sees as low defense spending by European members of NATO. In Brussels, he pressed them to spend even more than their agreed-upon level of 2% of GDP, up to 4%. That met with a less than enthusiastic response from the Secretary General of NATO.
I will focus on what we have agreed, and we have agreed to be committed to the pledge increasing defense spending to 2%. And let's start with that. So we have a way to go, but the good news is that we have really started to deliver.
Tomorrow, President Trump takes part in a multilateral session with the leaders of Georgia and Ukraine, and then he'll fly directly to England, where he meets with the politically embattled British Prime Minister Theresa May. For Nightly Business Report, I'm Eamon Javers in Brussels.
Broadcom may be closing in on CA Technologies. That's where we begin tonight's market focus. After the bell, the Wall Street Journal reported that the chipmaker was close to acquiring the software firm for about $18 billion. The deal would come just months after the White House blocked Broadcom's more than $100 billion bid for Qualcomm. Shares of Broadcom initially fell in after hours, and they finished the regular day on the downside by nearly 3% to $243.44. Meanwhile, shares of CA Tech initially rose in extended hours and finished the regular day up a tick to $37.21. Activision Blizzard is bringing its esports video game league mainstream, inking a multi-year deal with Disney to broadcast matches on ESPN and ABC starting today. The deal highlights the growing popularity for esports gaming, and some market watchers expect to reach into the billions of dollars in just a few years. Activision shares climbed 3% to $78.61. Disney rose almost 2% to $108.04. Pfizer said it plans to reorganize into three parts: an innovative medicines division, an established medicines unit, and its consumer healthcare business. The drug maker is still mulling over options for its consumer healthcare business, which makes Advil. Separately, the company said it would delay price hikes on a number of its treatments after it received criticism from President Trump. Pfizer shares fell a fraction to $37.21.
Industrial parts distributor MSC Industrial said that growth in e-commerce orders led to a rise in earnings and revenue, and even though profits were in line with estimates, sales missed the mark. The company also warned that it's beginning to see some price increases from suppliers due to increased tariffs. Shares fell nearly 4.5% today to $80.86. Fastenal, that makes industrial and construction products as well. It delivered earnings that were well ahead of estimates. Company also raised its quarterly dividend to 40 cents a share. Company was the best performing stock in the S&P 500 today. It was up 10% to $54.51. And Papa John's CEO has found himself in hot water once again. Chief Executive John Schnatter admitted to using a racial slur on a conference call with analysts in May. He has apologized and said that racism has no place in society. Last year, Schnatter created a stir after saying that sales were hurt by the NFL's handling of players kneeling during the national anthem. Shares finished down nearly 5% today to $48.33.
It's that time of year again when some of the most powerful and influential media and tech executives go to Sun Valley, Idaho to attend the Allen & Company conference. And this year, the drama centers on deals. Julia Borston is there.
In beautiful Sun Valley, Idaho, deals are in the spotlight, specifically the battles over Fox and Sky, with Fox Chairman Rupert Murdoch and Comcast CEO Brian Roberts both here. Fox just upped its offer for Sky to top Comcast's bid, and Comcast is expected to counter quickly. We asked Murdoch if this could spark a bidding war. How high are you willing to go for Sky?
That's it.
That's it? Not higher?
We'll see.
We'll see. The battle for Fox and Sky and the completion of AT&T's acquisition of Time Warner are expected to kick off the next wave of deals. And the growing valuations of Fox and Sky speak to the growing value of premium content companies and the scarcity of acquisition targets.
There's an expectation that there's going to be more M&A across the board, just in terms of the media landscape. You know, there's been a lot of deals that have already happened, and there's a lot of deals in process right now. But you know, there's only a limited amount of beachfront property out there, and I think that when you think about what you're seeing in terms of some of the bidding cycles and things happening today, the companies are trying to stay with the consumers and they're trying to stay with scale.
So who are potential buyers? Barry Diller, chairman of IAC, is reportedly looking at buying Groupon. And Liberty Media's Greg Maffei is here. Though Chairman John Malone isn't, we hear Maffei is meeting about potential deals and partnerships for Liberty's companies. No comment from Jeff Bezos when asked if he's interested in buying a media company for Amazon, but there's plenty of speculation that a tech giant such as Amazon or Apple will make a big move into media.
I think when Amazon and Apple and Netflix can bring so much capital to bear to invest in content, Netflix investing billions of dollars a year in content, it necessitates some consolidation in certain areas of the industry, and I expect you will see a lot more of it.
And it's not just the public media and tech giants here. Uber CEO Dara Khosrowshahi is here, along with Uber's largest shareholder, SoftBank's Masayoshi Son. He told us yesterday that he's interested in cybersecurity and AI companies, and there are several of those companies speaking behind closed doors here at the conference. For Nightly Business Report, I'm Julia Borston in Sun Valley, Idaho.
And late tonight, Comcast increased its offer for Sky to $34 billion. That trumps Fox's earlier offer of about $32.5 billion for those assets.
Still ahead. So where were you 10 years ago today?
A decade ago, a key event happened in Pasadena, California. On this day in 2008, the feds seized mortgage lender IndyMac, and that eventually led to the greatest financial crisis in a generation. Jane Wells takes a look back to see how far we've come.
It was a scary time. 10 years ago, in July 2008, people waited for hours to get inside IndyMac bank branches to withdraw all their money.
I wish I had known my bank better.
I just hope to be able to get my money back. That's all. This is my life savings.
Yeah, we're going to put it into another bank, and, you know, that one might go belly up any day now, too. So what are you going to do?
It goes around the block behind me to get into the branch here at the headquarters. But the lines were long, and the entire country watched. That was Monday, July 14th. The FDIC had shut down the bank the previous Friday afternoon, July 11th, because IndyMac had made too many risky mortgages, could no longer find investors willing to buy them as securities, and because earlier reports that it was on shaky financial ground had already led to a flood of withdrawals.
Well, it was pretty agonizing.
Sheila Bair headed the FDIC back then, which spent over $12 billion covering deposits, not just to the insured limit at the time of $100,000, but up to the new limit of $250,000. She then sold what remained of the bank to a group headed by Steve Mnuchin, who renamed it One West.
At some point, this market will stabilize, and being a bank in that market will be an attractive opportunity for us.
But the market wasn't attractive in 2008. 25 banks disappeared that year, some of them predicted by analyst Dick Beauvais, who doesn't think such a collapse will happen again anytime soon.
At some point in time, we will run into a period where debt is growing faster than income, and that will result in some sort of a setback for the financial industry. But it's not happening right now, and it looks like it's going to be tougher to make it happen in the future.
We have the CFPB, which I hope is it's still going to be continuing to operate, and especially in the mortgage lending space. We needed mortgage lending standards. Didn't have them then. We got them now.
Good morning. Good morning.
Looking back on that stressful weekend, Sheila Bair wishes she had not allowed IndyMac's immediate overseer, the Office of Thrift Supervision, or OTS, to close the bank on a Friday in the middle of the afternoon, freaking out customers.
If there's one mistake, I still kick myself for that. It's that we should have waited until the regular closing hours were over before we closed the bank.
By the way, one other change since 2008, the OTS no longer exists. For Nightly Business Report, Jane Wells, Pasadena, California.
Seems like yesterday.
Oof.
That does it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. We'll see you tomorrow.